When we invest, there will probably be a risk involved and a chance that we might lose. What kind of risks is our portfolio exposed to? Here with us today is Ilan Glasser, financial planner and portfolio analyst from Pioneer Wealth Management, who will tell us about risk management. Hello, Ilan.
Hi, Ronnie.
So what type of risks exist?
Well, in investing, there are many risks. But before we go into the risks that we're exposed to in our portfolio, it's important to understand what risk is exactly.
Okay.
So risk, in plain terms, it's no statistical number, it's not variance of outcome, it's simply being in a dangerous situation. And for us, that's the ability to lose money. So we'll discuss a couple of risks that our portfolio is exposed to. We'll start with capital risk. Investing in capital markets, by definition, puts our capital at risk. Whether investing in bonds or in equities, our capital is always at risk. And we need to make sure that we're aware of that risk and that we control that risk. This brings us on to another type of risk, which is taxes and inflation. Taxes and inflation are one of the two biggest factors that can erode your capital. Inflation, it's a silent killer, it's out there, nobody talks about it, but when your money is sitting in cash and not working, your purchasing power simply gets eroded year after year. So not investing is simply not an option.
Okay.
And obviously taxes. Every country's got a different tax regime, and the laws differ from country to country and state to state. But as a rule, on any profit, you have to share your profits with the government. So a lot of times people look at an investment and say, hey, we've really done well on it, but forget that they've got to pay part of their profits to the state.
What other types exist?
Well, you look at you open up any newspaper today and you see the situation that's going on in the world. The economic risk. The data that's coming out is highly on a high frequency. And people try to manipulate that data to better their portfolios. It's difficult, very difficult to control. But for a general rule, the economic risk works like this. When the economic situation is good, the markets tend to ride that momentum, and when the economic situation is bad, we see the exact opposite. I'll take you back to 2008. We saw an economic crisis, so we saw the market crash. Same thing, stock markets went down, bond markets, equity markets. It was the same relationship. When things are going good, markets go good. When things are going bad, markets go bad. A lot of the times when we meet investors, I always like to ask them what they think the biggest risk is for them. And for yourself, what do you think the biggest risk is? I don't know.
What's the biggest risk for me? I don't know. The fear, the way I handle it.
That's usually the answer that I get from people.
Okay.
And the truth is, it's a lot closer to home than people think.
Okay.
The
money's
biggest
not
risk,
out there; it's right here.
That's right.
Okay,
fair enough. The biggest risk when investing is probably yourself. The personal risk, the emotional attachment to your investment. And that's because when we invest, it's not recommended to invest with your emotions. It's recommended to invest with a cool, calm head. And when we invest in a company or whatever it might be, a bond, an equity, we need to invest because it makes financial sense, not because we like the company or we don't like the company. It needs to agree with our risk profile. Is it too dangerous for us, or is it not suited for what I'm looking for? Once we've set out that it makes economic sense, then we can invest in it. And a lot of the times, people have a difficult time detaching their emotions from the investment.
And you were mentioning before another type that sounded more exotic.
That's the crocodile risk.
Yeah, that one.
You're crossing the road.
Okay.
You check left, you check right, no buses, no cars, all safe. You take your first step and a crocodile bites you.
That sounds upsetting.
That's upsetting.
Okay.
But it always happens. When investing, the crocodile risk, it's that unexpected risk. It's that black swan you're not expecting. It comes out of nowhere, and it can literally destroy a portfolio.
But the only thing that's certain is that it will come at some point. We don't know what will come, but it will come.
Yes, I'm not talking about a major crisis, but I'm talking about that unexpected risk. A lot of the times you think your portfolio is built correctly, and you think that I've got everything under control, because a certain aspect isn't a risk, and it turns out that that's the actual risk that's out there. So it's something we need to be aware of. It's something that you can control. It's something that we can manage. With proper risk management, you can make sure that your portfolio doesn't get damaged too badly when it comes out, and it's just a matter of time when it does. You need to make sure that the portfolio is built robust in a durable manner so that it can take those shocks and not fall to pieces.
Ilan Glasser, thank you so much.
Thank you very much.